Hi, welcome back to Wesbury 101. I'm Brian Wesbury, Chief Economist at First Trust Portfolios in Wheaton, Illinois. Remember, we want to be the antidote to conventional wisdom. Well, the conventional wisdom is here on Thursday, October 1st, with the Dow Jones down 100 points this morning, that the market is in a correction, and that correction maybe even means that the bull market is over and we're going back down. I don't believe this for a minute, but let me just kind of go through some of the thoughts that people are having. One email I got said that this Business Week cover story, because it says why the market will keep going up, it's got this guy climbing the stairs, is a perfect contrarian indicator. Oops, they said, that's it, the market's over. But I guess they didn't read the cover closely enough, because on the bottom of the stairs, if you turn the magazine over, it says why the market is going nowhere. And in fact, isn't that the debate that we're having today? Well, there's a couple parts of that debate. That is, number one, is the economy really in a V-shaped recovery? Is this recovery going to last? And my answer is yes. We've got a few pieces of data today and in the past few days that are very positive. The Institute for Supply Management Manufacturing Index was 52.6% in September. It's now been above 50 for the last 2 months. The production portion of it, the new orders portion of it, were both very strong. It's not just cash for clunkers, says Norbert Orr, who puts this number together. It really does show that inventory levels are too low. Manufacturing is picking up. In addition, construction spending for the month of August came out. It was up 0.8%. The consensus expected it to be down. This wasn't because of stimulus spending. In fact, public expenditures on construction were down 1.1%. It was private that was up 1.8%, and the real boost to the private construction was in the residential area, the home building area, which was up 4.7% in August. That's the strongest month we've seen since 1993, 16 years ago. In addition, the Case-Shiller Home Price Index shows that 15 out of 20 cities, measured by their 20-city index, 75% of the cities over a 3-month basis have prices up from where they were 3 months ago. And by the way, on a monthly average, we've now had 2 straight months of an overall price increase on average for the nation as a whole. And then one more piece of data in the personal income data that we had for the month of August. We had great news on small business earnings that were up 0.7% in August, and they're up 7.6% at an annual rate in the last 3 months. Now remember, these are supposedly the businesses that can't get loans, that are tied up because of tight credit, that have problems with real estate. In fact, all of these things, with the price of housing, construction activity, small business incomes picking up, it shows me that this V-shaped recovery has legs. Now, having said that, there's still a great many people out there who believe that this market is just ready for a fall. And in fact, one of the stories that people are telling most often is that in 1930, after the 29 crash, the market fell about 50%. Then it rallied 50%. That sounds familiar, doesn't it? That's what we've done in just the last few years, only after rallying by 50% to collapse again. So let's take a look at the chart of the stock market between 1929 and 1931. And I want to talk about why this happened. The real reason for the bottoming of the market in late 1929 after the collapse was because that President Hoover listened to Andrew Mellon and cut individual income tax rates by 1%. This was a significant cut. It was a change in direction. It made it seem like the president was listening to Mellon, and he was the one, I think, that could have fixed the depression before it got worse. And the market, in fact, responded well and rallied. Also, at the same time, the market was beginning to believe that maybe the Smoot-Hawley Tariff Act, remember, that was passed by the Senate committees and House committees back in 1929, which really led to the crash, but that maybe Herbert Hoover was not going to sign the Smoot-Hawley tariff into law. 1,000 economists petitioned the president, said that protectionism was a terrible thing, and for a little while it looked like Mellon, was in control and maybe some sanity would prevail. But then all of a sudden in 1930 you can see the market turning over and then collapsing as the Smoot-Hawley law was signed, tariff was signed into law. So really what brought the market up back then was a tax cut, and then the tariff collapsed it again, and that led to the Great Depression. So this idea that somehow the market goes down and then up and then down, and that's what we're going to follow here, I just don't buy it. There's not the same kinds of legislation on the table today. Yes, we're talking about tax hikes, but those aren't going to happen until 2011 or beyond, possibly even 2012 or 2013. Yes, we're talking about a major increase in government involvement in the healthcare system, nationalizing the healthcare system, but literally we don't know whether that will pass yet or not. We have no idea. In fact, I would say the odds right now are about 50-50. We are also talking about cap and trade. That's also probably less than 50% chance of being passed. And when you really look at these bills, cap and trade won't affect the economy in any real negative way for another 8, 9, 10 years out into the future. And the health care bill, it will take a long time for any public option or co-ops or those kinds of things to really disrupt the system. Probably 2 or 3 or 4 years before we see any major impact from this. So this idea that somehow we're going to pass some piece of legislation today, or that the economy, in the other sense, is going to fall off the edge of another cliff, I just don't think hold water. And so what led to the collapse in the market in the 1930s isn't here. I do not think the economy is in any kind of trouble. In fact, a V-shaped recovery is underway. As a result, the market remains undervalued by 40%. Before it's all over, we are going back to pre-Lehman levels, which means 12,000 on the Dow, 1,200 on the S&P, maybe further if we get good policies. We don't pass tax hikes, we don't pass health care, we don't pass cap and trade. I don't know. You don't know whether any of those things are going to pass, and we could end up even going past that 12,000, 1,200 level if that were to happen. But the bottom line is that as we sit today, the economy continues to grow. The data show continued growth. The market may have a correction. I don't know, and I'm going to suggest that probably you don't know whether it will or won't. But if it does, it will be another great buying opportunity. More likely, it's more of a head fake on the downside that will turn around and move off to new highs before the month is out. Thanks for visiting Wesbury 101. Remember, we want to be the antidote to conventional wisdom. We'll see you next time.